Low doc loans are ideal for borrowers who do not meet traditional lending criteria. But does that mean you have to pay a higher interest rate? Not necessarily. Hey everyone, Louis Dip here from Odin Finance, helping you with all your asset finance needs. Low doc loans let borrowers apply for asset finance with little to no paperwork, hence the name low doc loans. For some borrowers such as self-employed people, ABN holders, sole traders and contractors, applying for a low doc loan is simpler than applying for a standard loan because they don't need to provide standard proof of income such as financials and tax returns. But the assumption about this type of arrangement is that you ultimately have to pay a higher interest rate to compensate for the fact that you haven't been able to paint the entire picture for the lender. For the most part, this isn't necessarily a wrong assumption, but I will say this. Low doc loans in the asset finance space are quite different in certain ways to those in the residential space, which means you might not actually have to pay a higher interest rate, and in today's video, I'm going to explain why. But before I do, you should know that this video must not be construed as professional or financial advice. In particular, you should seek independent financial guidance from a professional who can advise you on your best ways to proceed in your personal circumstances. Alright, so in the asset finance space, if you meet the certain criteria and the asset meets the necessary criteria, you may be eligible for a low doc product at the same rates as a full doc loan. For example, Westpac offers a low doc product for ABN holders who are asset backed and have been trading more than 2 years and have a GST period longer than 1 day. You'll then be able to buy vehicles for up to $150,000 as long as they're not older than 5 years old. This means that you'll be able to borrow up to this amount without having to provide company financials and tax returns. And the interest rate is the same as if you had applied for a full doc loan of the same value. At the end of the day, it comes down to the asset and how much is being financed. Unfortunately, if we use the same scenario, you wouldn't be able to secure the low doc loan with Westpac if you're looking to finance a $200,000 prime mover truck. You would have to go down the full doc loan route. But that doesn't mean you're out of options. If you don't meet the criteria and you don't have the necessary documentation, we can explore more low doc or no doc options with second tier lenders. The only snag would be that with the second tier lenders, there is a much more higher probability that you have to pay a higher interest rate. So I just want to show you that higher interest rates aren't necessarily always the case with low doc loans in the asset finance space. You just have to know where to look. And that's where a broker comes in handy. A broker can help you compare different lenders and find the low doc loan that best suits your needs. If you have any questions about your ability to secure a low doc loan at a reasonable interest rate, please feel free to reach out to the Odin team. We'll be happy to answer your questions, and if you find this video insightful, please share it with your friends. The more people we can help, the better. See you next time.